Have you ever wondered how the stock market works? It's a bustling world of numbers and graphs that can seem daunting at first, but let's break it down into digestible pieces. Think of the stock market as a grand marketplace, similar to the bustling bazaars or modern-day e-commerce platforms. Instead of selling fruits, vegetables, or clothes, this marketplace trades in stocks. Now you might ask, what are stocks? Simply put, stocks are a piece of ownership in a company. When you buy a stock, you are buying a small piece of that company. Now, just like any marketplace, the stock market is a meeting place for buyers and sellers. But instead of haggling over the price of apples or the latest fashion, these buyers and sellers negotiate on the price of stocks. These stocks represent publicly traded companies, from tech giants to retail conglomerates, from healthcare providers to energy utilities. The beauty of the stock market is that it's open to everyone. You, me, your neighbor, anybody can participate. It doesn't matter if you are a multi-billionaire or a college student with a few $100s to spare. The stock market is a democratic platform where everyone has the opportunity to own a piece of a publicly traded company. So how does this marketplace function? Well, it operates through a network of exchanges. You might have heard of the New York Stock Exchange or the Nasdaq. Companies list their stocks on these exchanges where they are bought and sold. The price of each stock is determined by supply and demand. If more people want to buy a stock than sell it, the price goes up. If more people want to sell a stock than buy it, the price goes down. In essence, the stock market is a dynamic, ever-changing ecosystem where billions of dollars are exchanged daily. It's a place where fortunes can be made, and yes, also lost. But with knowledge, research, and a little bit of luck, it can be a rewarding journey. Now that you have a basic understanding of what the stock market is, it's time to delve deeper. So, how exactly does the stock market operate? Well, let's break it down. The stock market is essentially a marketplace for buying and selling shares, which are small portions of ownership in a company. When you buy a share, you're essentially buying a bit of that company. But how does the buying and selling happen? This is where stockbrokers come into play. They act as the middlemen between buyers and sellers. In the old days, trading used to happen on the floor of the stock exchange, with brokers shouting orders. Today, it's all done electronically, which makes the process faster and more efficient. Now let's say a company decides it wants to raise money to expand its business. It can do this by listing its shares on the stock market, a process known as an initial public offering, or IPO for short. The company will decide how many shares it wants to sell and at what price. This is usually done with the help of investment banks. Once the shares are listed, they can be bought and sold by investors on the stock market. The price of these shares will fluctuate based on supply and demand. If more people want to buy the shares than sell them, the price will go up. Conversely, if more people want to sell the shares than buy them, the price will go down. It's important to remember that the stock market is not a one-way street. You can both make and lose money. The goal of most investors is to buy low and sell high. However, the stock market is influenced by a multitude of factors, including economic indicators, company news, and global events, all of which can affect the price of shares. The stock market is a complex machine with millions of transactions happening every day. It's a place of opportunity where fortunes can be made and lost. It's a world of numbers, charts, and percentages. But at its core, it's about people who believe in a company's potential and are willing to invest their money in its future. With the mechanics of the stock market now clear, we can move on to the different types of markets. Did you know there are different types of stock markets? Indeed, the world of stock trading isn't as straightforward as it might first appear. It's not just a single monolithic marketplace, but rather a complex system of differing markets, each with its own unique characteristics and functions. Today, let's delve into two of the most important ones: the primary and secondary markets. The primary market, also known as the new issues market, is where securities are created. It's the venue where companies, governments, or public sector institutions can raise capital by issuing shares or bonds directly to investors. Think of it as the birthplace of securities. When a company decides to go public and launch an initial public offering or IPO, for example, it's happening in the primary market. The funds raised from these sales go directly to the issuer, but what happens once these securities have been issued? Well, they don't just vanish into thin air, do they? This is where the secondary market comes into play. The secondary market is where investors trade securities amongst themselves. It's the hustle and bustle of the stock exchange that you're probably picturing in your mind right now. It's where shares, bonds, options, futures, and other types of securities change hands after their initial issuance in the primary market. Unlike the primary market, the issuer does not receive any funds from these transactions. So why are these markets important? Well, the primary market enables issuers to raise capital for growth and development, while the secondary market provides liquidity, meaning securities can be bought and sold with ease. This liquidity is crucial as it provides investors with the flexibility to enter or exit investments according to their financial goals and risk tolerance. In essence, the primary and secondary markets are two sides of the same coin, each playing a critical role in the functioning of the stock market. They are the backbone of the financial system, facilitating the flow of funds from those who have excess capital to those in need of capital. Understanding the different markets is key to your journey in the stock market world. Ever wondered why stock prices go up and down? It's a question that has puzzled many an investor, but the answer is more straightforward than you might think. There are three primary factors that influence the rise and fall of a stock's price: company performance, economic indicators, and market sentiment. Let's start with company performance. This is the bread and butter of stock price fluctuations. If a company is doing well, showing strong earnings and a bright future, its stock price will likely increase. On the other hand, if a company is underperforming or if there's bad news on the horizon, the stock price may drop. This is because investors are buying a piece of the company when they buy stocks, so the company's fortunes directly affect the value of the investment. Next, we have economic indicators. These are the big picture factors that influence the market as a whole. Think about things like interest rates, inflation, and unemployment rates. When the economy is strong, people have more money to invest, which can drive up stock prices. Conversely, when the economy is weak, people may pull their money out of stocks, causing prices to fall. Lastly, we have market sentiment. This is the trickiest factor to pin down because it's all about psychology. Market sentiment is how investors feel about the market in general or a particular stock. If investors are feeling bullish, they'll buy more, driving up prices. If they're feeling bearish, they'll sell, causing prices to drop. Understanding these three factors, company performance, economic indicators, and market sentiment, can help you make sense of why stock prices fluctuate. It's not a perfect science and other factors can come into play, but these are the big three to keep in mind. So, the next time you see a stock price go up or down, you'll have a better idea of why it's happening. And remember, while it's important to understand these fluctuations, it's equally important not to let them dictate your investment strategy. Stick to your plan, stay diversified, and invest for the long term. Grasping why stock prices fluctuate will give you better insight when investing. Scene script. Ever heard of the phrase, "Don't put all your eggs in one basket"? Well, in the realm of investing, this old adage holds true, and it's known as diversification. Diversification is a risk management strategy that involves spreading investments across various financial instruments, industries, and other categories. It aims to maximize returns by investing in different areas that would each react differently to the same event. Think of it as a kind of insurance against the unpredictable market. Now, why is diversification so important? Well, in the world of investing, the future is always uncertain. Each investment carries a degree of risk, and while some risks can be managed, others like market risk cannot be controlled. That's where diversification comes in. By spreading your investments across a variety of assets, you reduce the impact of any one investment performing poorly. Let's imagine you've invested all your money in the technology sector. If that sector takes a downturn, your entire portfolio would suffer. But if you had spread your investments across technology, healthcare, manufacturing, and other sectors, a downturn in any one sector would be balanced by the performance of others. Diversification doesn't guarantee profits or protect against loss in declining markets. However, it can reduce the potential for a major loss that could occur from concentrating all your capital in one investment or one sector. Diversification also allows for potential upside. While one sector is declining, another might be on the rise. So, diversification can provide a potential for balanced growth with lower risk. Remember, diversification isn't about building a bulletproof portfolio. It's about managing risk and ensuring you're not overly exposed to any one investment. It's about balance and spreading risk to enhance potential returns. Remember, the goal of diversification is not necessarily to boost performance. It won't ensure gains or guarantee against losses. But once you choose to target a level of risk based on your goals, time horizon, and tolerance for volatility, diversification may provide the potential to improve returns for that level of risk. Diversification is one of the key strategies used by successful investors. It's a fundamental concept that's essential to creating a balanced, risk-managed portfolio. So, don't put all your eggs in one basket. Spread them out and watch them grow. Investing in the stock market is not without its risks, but it also has its rewards. It's like embarking on a thrilling adventure where the highs can be exhilarating, but the lows, quite daunting. So let's delve into the nitty-gritty of what these risks and rewards entail. First and foremost, we have market risk. This is the risk that the entire market will decline, pulling down the value of individual stocks with it. The market can be impacted by a myriad of factors ranging from economic indicators, geopolitical events, and even weather phenomena. It's like a riptide that can pull even the strongest swimmers out to sea. Then, there's the business risk. This is the risk that the company whose stock you own might underperform or go bankrupt. It's like betting on a racehorse. If your horse stumbles, you lose, regardless of how well the other horses perform. But fear not, brave adventurer, for with great risk comes great reward. The potential for high returns is the gleaming treasure chest at the end of this perilous journey. Stocks have historically provided higher returns than other investments like bonds or savings accounts. Over the long haul, investing in the stock market could significantly grow your wealth. There's also the reward of dividends. Some companies distribute a portion of their earnings back to shareholders. It's like the cherry on top of the sundae, a sweet little bonus for trusting in the company. And let's not forget, investing in the stock market gives you a chance to be a part of something bigger. When you buy a stock, you're buying a piece of a company, a stake in its vision and future. You're not just a bystander, but a participant in the global economy. But here's the key takeaway. The stock market is not a get-rich-quick scheme. It's a long-term game that requires patience, strategy, and a solid understanding of the risks involved. So equip yourself with knowledge because, as we all know, knowledge is power when it comes to investing. Ever wondered how to choose which stocks to invest in? Well, the answer lies in one of the most crucial aspects of investing: research. Let's delve into the significance of this pivotal step. Investing in the stock market isn't akin to playing a game of chance. It's not about picking the most popular stocks or following the crowd. It's about making informed decisions based on thorough research. This is where the adage, knowledge is power, truly shines. The more you know about a company and its stocks, the better equipped you are to make wise investment decisions. So, what does doing your own research entail? It involves understanding the company's fundamentals. This includes evaluating its financial health, studying its performance over the years, and being aware of its future prospects. It's about digging into its balance sheets, income statements, and cash flow statements. It's about understanding the industry it operates in, and the potential challenges it might face. Furthermore, it's not just about numbers and facts. It's also about discerning the qualitative aspects. For instance, the company's management quality, its competitive advantage, and its corporate governance practices also play a significant role. Now you might wonder why you can't simply rely on expert advice or financial news. While these sources can provide valuable insights, they should be used to supplement your own research, not replace it. After all, it's your money at stake and nobody will care about it as much as you do. And remember, research isn't a one-time thing. The stock market is dynamic and so are the companies. Therefore, keeping up with the latest developments and continuously updating your knowledge is paramount. To sum up, research is your compass in the world of investing. It guides you, helps you navigate through the complexities, and ultimately leads you towards your financial goals. So, don't skip on it. Make it an integral part of your investment process. After all, doing your own research is a critical step in your investment journey. So, there you have it, a beginner's guide to the stock market. We've journeyed through the basics, understanding the mechanics, and highlighting the different types of markets. We've delved into the reasons behind stock price fluctuations and emphasized the importance of diversifying your portfolio. We also discussed the potential risks and rewards that come with investing in the stock market. It's not always a smooth ride, but with knowledge and a calculated approach, it can be a rewarding venture. We underlined the critical role of research in making informed investment decisions. Knowledge truly is power when it comes to investing. In this complex world of stocks and investments, remember that every expert was once a beginner. It takes time, patience, and continuous learning to navigate the stock market. But with each step, you're building your financial future. Remember, investing in the stock market is a journey, not a destination. Happy investing!